Today I'm going to be discussing how to hack the capital formation process as a life sciences company. Specifically, I'm going to be covering 7 highly useful hacks that are designed to help private life sciences companies overcome both immediate and long-term capital raising challenges. And towards the end of this presentation, I will also be sharing some tools that you can use for implementation. Okay, before I get into the core discussion topics, I'd like to share just a little bit about my background so that you know I'm coming from a place of practical, real-world, in-the-trenches type experience. For the past 15 years or so, I have participated in the capital markets in a number of capacities. Through Glassbox Law and its predecessor firm, I have served as outside legal counsel for both large and small venture capital firms and private equity groups. I have also represented a diverse array of issuers in the capital raising process, consulting on the drafting of Reg A, Reg D, and S1 registered offerings. I have served as an executive and senior legal counsel within one of the largest self-clearing broker-dealers in the United States, which at one point serviced over 100 correspondent firms, many of which had robust investment banking divisions. I have founded and operated a mortgage bank which sold and continues to sell a large volume of loans into the secondary market, and I have invested directly in multiple private businesses. Really, the point of me sharing this slide with you is just to note that I have been afforded a fairly unique perspective on the capital raising process, and I'm hoping to share some of the insights I've gained here today. Okay, so what is a hack? This presentation is all about hacks. Hacks to more efficiently raise funds, hacks to give you a better chance at growing your business, hacks that can mean the difference between failure and success. A lot of people like to think of a hack as a shortcut, maybe even some sort of devious shortcut. Personally, I don't think of a hack in these terms. To me, a hack is simply another term for an efficient solution. And by efficient, I don't necessarily mean easy or fast. In fact, the type of hack that I'm going to be talking about today can take a lot of time, dedication, and hard work to implement. But the net result of the type of hack that I'm talking about is an elegant solution to an often challenging or complex problem. The type of hack that I'm going to be talking about can actually make your whole business stronger for many years to come. I'm going to break this presentation down into 2 sets of challenges and 2 sets of solutions. First, we are going to talk about the immediate challenges that private life sciences companies face when trying to raise capital, and the hacks that can be employed to address these challenges. Then, I'm going to talk about some of the long-term challenges that these companies face and the corresponding solutions. To begin, here are the immediate challenges that you are likely facing today. The first challenge, well, that's the long time horizon associated with an investment in your company. The second challenge, that's the large amount of information a new investor must digest to make an investment in your company. And the third challenge, that's the relatively limited pool of investors that you can pursue. Okay, challenge number 1. Many of you have a long, often excruciatingly long time horizon ahead of you before your investors can realize an exit. In fact, as a life sciences company, you may not even know what shape an exit may take, when it may happen, or whether the regulatory climate might force you to change directions midway through your journey and push your prospective exit out even more indefinitely. And I'm sure it goes without saying, but the fundraising world takes major issue with this. In fact, the lengthening of investment time horizons that we are seeing right now is one of the big reasons why some VC groups that have historically invested in medical devices and biotech companies are shifting away from life sciences entirely. So why am I bringing this up? If you have a long investment time horizon with an amorphous exit plan, you are going to dramatically limit the pool of investors who will be willing to participate in your deal, and further, you're going to limit the amount of capital you will be able to get from any investor who is willing to participate. If you really think about it, most investors want to realize returns in a 3 to 5, maybe 7-year type time frame. And when you try to design an early stage investment in a life sciences company to meet this sort of time horizon, it typically doesn't work. So here's the hack. You need to make sure that investors considering subscribing for equity in your company have a viable escape hatch through a second market for your shares. This will actually open up a larger pool of investors for you and may make those investors already willing to invest more comfortable and confident, in fact, so much so that they may be willing to invest even more capital. Let me explain exactly what I'm talking about here. Let's say you sell shares to an investor that for one reason or another needs to liquidate their position before any sort of exit milestone is achieved. That investor will be in a much better position if not only they have the option to sell their shares back to the company, but also the option to sell their shares to another independent investor via a second market for your stock. Now, I'm not talking about becoming a public company to open up a second market. In fact, I would highly discourage almost any life sciences company from choosing to become public out of the gate, simply to give their investors access to the over-the-counter second market. The cost associated with being a public company, even on the OTC, is disproportionate to the benefit, and frankly, your time and money, at least I should say at the early stages of your company's life cycle, and the time and money that you're going to be spending on maintaining your public filings and the human resources that go into that is really better spent on your actual business in the early stages of your life cycle. However, there is another option, a better option for opening up a second market for your stock. You can join a more discreet platform that gives you the ability to share your corporate data selectively with second market investors. This type of platform will also give you the ability to track and share the lineage of all of your stock issuances, and it will make it possible for you to share relevant updates, financial and otherwise, with existing and prospective investors. Further, once you are on this type of platform, you may be able to qualify for your shares to be deposited in a conventional stock brokerage account where your shares can be listed on an investor's account statement, as opposed to simply giving your investors a quarterly or annual letter that tells them how the company is doing. They'll actually see their shares on a brokerage statement, assuming they join this type of platform that I'm talking about. If you jump on a platform like what I'm describing, all of these features that I just mentioned can enable a true second market to develop in your stock without you having to incur the time and financial burdens typically associated with becoming a lower tier public company. Now, this first hack that I'm sharing with you may in fact be the most important hack in my entire presentation. So I really want to pause for a moment and let this one resonate. You can actually solve for your long time horizon challenge by supporting a second market in your stock. This can be a very powerful hack in the capital raising process. Later in this presentation, I will share some information on exactly how you can implement this strategy. Okay, so moving on to immediate challenge number 2. With life sciences offerings, an investor often needs to understand an entirely new context, an entirely new world, really, to be able to properly assess the value of what it is your company is trying to create. This means your investors have to read and digest tons of content, and it can be extremely hard to deliver that content in a manner that's not overwhelming. What you have to offer is a lot different than, say, a real estate investment company or even a software firm. You have changing regulations, clinical studies, competitors that may be attacking the same problem but with a slightly different approach, which means you have to explain a bunch of background and a bunch of information just to support your position and have your investors feel comfortable that they understand the world you're operating within. So here's the hack for challenge number 2. Don't try to spoon feed everything to your investors via a standalone deck or even a series of decks. Don't think that if you give them 1,000 pages of content, but just dribble it out over time, it's going to be okay. Create a more interactive environment for them, where your investors can educate themselves in a manner and in an order that they see fit, using a wide range of well-organized source materials. And try to use video whenever possible to humanize your presentation. To accomplish these objectives, I would recommend using a portal or platform that lets you distribute data via a private data room that is organized specifically for securities offerings. Again, later I will give you some specific ideas for implementation on this, but I can't drive this point home enough. When you're trying to engage investors, the last thing you want to do is overwhelm them with thousands of pages of data and make them feel like they're going to have to go through a college course just to understand what problem you're trying to solve. So having your data properly organized and set up in a manner where the investor can take some control over how they educate themselves is highly, highly beneficial. Okay, so finally, this brings me to the last of our immediate challenges. As you know, there is an exceptionally narrow group of investors that are both interested in and capable of investing in private life sciences companies. Now, that is not to say there isn't a lot of money out there for these types of ventures. It's just controlled by a small group of players. Investment management firm Baillie Gifford, for example, has deployed billions in this space alone. Now, there's a lot of money there's a lot of money seeking to be placed into life sciences companies. The challenge you have here, however, is that with a narrow audience, you can't promote your offering in the way, say, a software company might promote, or a building products company might promote, or even a financial services company. So how do you best address the fact that there's a relatively limited pool of investors that may have interest in your offering? As everyone listening to this already knows, life sciences investors typically come to the table with a special type of life experience or education. They often have a medical background, or they have a history of making investments in the space, or maybe they're closely associated with the issuer in some way, personally or professionally. You really can't just look at anyone on the street who meets the accredited investor status and ask them to take a look at your opportunity and ask them to invest. In fact, it's extremely difficult, if not imprudent, to approach a typical accredited investor with something that requires a specialized knowledge base to assess. So how do you broaden your access to capital when you are starting with such a limited pool of prospects? Here's the hack. You don't go broad, you go deep. In the life sciences space, you can't think of roadshowing your offering in the same way that everyone else does, where you're just going to go out and cast as wide a net as possible. Instead, you have to think of roadshowing as relationship building. Now, that relationship building doesn't have to be as daunting as it seems. Today, a lot of heavy lifting in the roadshow relationship building type of process that I'm talking about can be done digitally by creating specialized online groups for your existing and prospective investors, where you feed those members ongoing updates and engage them in ongoing dialogue. This will enable your members to build trust in you and be prepared to strike on your opportunity when the time horizons. Now, later on, I'm going to give you some ideas on implementation for this hack. Okay, now that I've discussed a few of the immediate capital raising challenges for life sciences companies, I want to touch on what I believe is your most critical long-term capital raising challenge: designing and implementing your long-term capital formation plan. A bad capital formation plan can have devastating consequences. Not only can you over-dilute your founders, but with a bad plan, you can inadvertently prevent your company from being able to raise more capital in the future and ultimately reach your milestones and your goals. Now, there's a few more hacks I want to touch on that can help you solve for this challenge. Okay, so hack number 4 that's going to help you design and implement a successful long-term capital formation plan. Stress test. When raising money to address an immediate need, you're going to want to think several funding rounds into the future, and you're going to need to plot out a variety of what-if scenarios based on different investment structures that investors may demand in the rounds ahead. The probability of certain theoretical investor demands in future rounds should drive the structure that you employ today. For example, Should you be issuing straight common stock? Maybe you need to offer preferred, maybe convertible preferred, maybe preferred with warrants. Or should you decide to forego equity entirely and finance your business with debt? If so, could this impact your ability to raise additional equity in the future? If you take on debt, what type of debt should it be? Maybe it should be venture debt. Maybe it should be asset-based, cash flow-based, or liquidity-based. Maybe even government guaranteed. And each one of these funding structures may have some sort of lurking landmine that will impact your ability to raise capital in the future. So you need to think through all of these different scenarios to really understand the future impacts that each one is going to have on your long-term plans. Finally, keep in mind that you are operating in a much bigger world than just your sector. You're always going to be dealing with global economic winds swirling all around you. So what others have done before in your sector may not necessarily be right for you at this given moment in time. Now, in my personal opinion, the best way to explore your capital formation options and properly stress test different structures is to find a seasoned investment banker in your space that has a history of completing successful offerings, and to use him or her as a guidepost. Now, don't try to go off of what you've heard from a friend in the space or what you've read in an article or a particular soundbite you might have caught at a conference. Find a banker that has been on the front lines of dozens of deals that can offer practical data points which you can build your model off of and stress test. Whatever banker you find is likely going to have a good sense not only of what's going on in your space, but what's going on in the larger economic environment. So it's going to be worth its weight in gold when you hire this investment banker and you're able to use them as a sounding board before you actually begin the capital raising process. Okay, hack number 5, to implement a successful long-term capital formation plan. Make it your mission to understand your investor's thesis. This may sound trite, but you need to interview your investor almost like they are interviewing you. If you understand what the other side is looking for, what risks they're trying to mitigate, what economic and social objectives they're trying to achieve, it's just common sense that you'll be able to negotiate a better deal for yourself. If you end up with 2 competing funds willing to invest in your company, it's not always the case that you should just be pitting one's terms against the other. You may instead want to consider the thesis of each fund and negotiate in 2 totally separate directions. And then at the end of the day, just take the deal that makes the most sense for you in the long term. Okay, next, hack number 6 to implement a successful long-term capital formation plan. Never get out of capital raising mode. This is going to sound crazy to some people, but let's say you've just completed a massive equity raise. Let's say it's a raise that in the back of your mind you questioned as even being possible, but you got it done. So is now the time to refocus all of your energy on operating your business? Absolutely not. You need to build on your momentum. If your deal was oversubscribed, you need to remind those people or entities that didn't get in that it's a big deal that they didn't get in. You really can't ever take your foot off the gas when it comes to raising capital. You need to maintain your presence at conferences, you need to maintain your communication with your existing investors, and you probably need to start hosting gatherings with your existing investors to talk about the future, even though you may not have the next raise planned. Capital formation is all about building momentum, building and maintaining momentum. If you keep your foot firmly planted on the gas, maybe even pressing down harder after you've had a couple big raises, you'll be maintaining awareness and building excitement for the future. So when your next offering comes around, it's going to be that much easier. Further, and perhaps equally as important, by staying in capital raising mode, you'll be supporting the second market for your stock, which again will help broaden your prospective pool of direct investors. And think back to hack number 1 that I talked about with regard to supporting a second market for the stock in your company. Once you do that, once you've committed to making information available to those people who are going to be reselling your shares, the new investors coming in that see that are going to feel more confident about investing with you. Okay, so this brings us to the final hack in this presentation. And this one also may sound a little crazy at first. To design and implement a successful long-term capital formation plan, you'll need to be resourceful, and you'll need to design your plan around not having to raise capital whenever possible. So what do I mean by this? Am I pulling the rug out from under this entire presentation with this last hack? No. Oftentimes, raising capital is the least resourceful way to solve a problem. Let's start with a simple example. Let's say you want to attract an executive that you think would be a perfect addition to your management team. But that executive has a pay rate twice that of what you've allocated in your pro forma. Your first inclination might be to go back to your investors, try to raise more capital, and just try to put a bow on this and raise the guy that you think is going to add a lot of value hire the guy that you think is going to add a lot of value for your organization. But before you do that, before you spend that money, perhaps there's a few other things you could consider. One, perhaps this new person could be hired in a hybrid role for the short term, possibly eliminating the need for another employee. So, maybe you are going to have to pay him what he's asking for, but if you're able to figure out a way to kind of have him wear two hats in the short term, you might be able to save capital by not having to fill another position. Okay, two, perhaps this person could be enticed to come work with you based on some limited term royalty or profit participation in future sales, which they could vest into. So here, what I'm talking about is, you give the new hire the opportunity to make a small piece of the gross off of whatever it is you're selling, maybe for some limited period of time until you can kind of catch them up to what they would be making, and that's going to put you in a position where you're not, burdened with making, very high salary payments every month. You're going to be basically paying out as your company is performing, and obviously this executive you're hiring is going to contribute to that performance. Okay, three, perhaps this person could be enticed with a laddered compensation plan. Maybe you start them out below their market rate, but you get them above their market rate once certain milestones are being met. So a lot of creativity that can go into compensation plans before you just sort of dole out the money that they are initially asking for. And obviously, anybody that you're looking to hire could be enticed with stock options. Deferring more of the employee's compensation into the future is really going to generate tons and tons of benefits. And I'm just using this as an example of how you can be more resourceful. You don't always have to raise more capital to solve what you think are capital constraints, or solve for what you think are capital constraints. If you rejigger things and you actually look beyond capital as a solution, you're going to generate tons of ancillary benefits. Actually, most of the time when you're able to be resourceful enough to avoid deploying capital to solve a problem, you actually end up with other side benefits. So an example in the employee scenario would be, your employee would obviously be much more tied to the success of the business, which is always a good thing. One of the things I think that's most important with this type of employee compensation plan that I'm talking about, where you're kind of tying the two interests together, is that you're setting a precedent for future hires. You bring in somebody really qualified under that type of structure, it's just going to become easier and easier after that to raise other talented people under similar structures, because you've set the benchmark, you've set the precedent. So the point I'm trying to make here with all this is that when a capital need arises, it's often a good idea to find a workaround. On this slide, I just want to offer a summary of the 7 hacks that we've covered already, and I want to give a few brief thoughts on implementation just after this. If there's a single theme that ties all of these hacks together, it's that thinking long term is essential, even when solving for the immediate term. So here's what we've covered. To solve for immediate capital raising challenges, you will be well served to develop and support a viable second market for your shares. Again, this is probably the single most important hack in the entire presentation. Totally overlooked by most private companies and game-changing for those who do focus on it. Okay, number 2, create an interactive environment for investors to educate themselves on your business. Again, investors can get completely overwhelmed when looking at complicated types of opportunities such as those in the life sciences space. So you have to be very careful, very strategic in how you introduce information to them and how you allow the investor to interact with that information. Okay, finally, as far as solving for immediate challenges in the capital raising process, you want to rethink roadshows as relationship building, not as marketing. This is not, a roadshow should not be considered just sort of like a presentation opportunity where you go in, you present your deck to 100 people, and you take off in a plane to the next destination when it's done. The roadshow actually it's more important at the roadshow that you develop real relationships with those people in the audience, whether they're interested in your opportunity at that time or not. You never know down the road where they're going to be. Maybe their capital's tied up in another investment right now. Maybe they don't have the ability or the sense yet to really understand your opportunity, but a year or two down the road, something may happen, something may click for those investors, for a group of those investors in the audience, and they may be a lot more receptive to what you're doing. So even if they're not immediately interested, building relationships with the people in the audience in your roadshows is critical when you're operating in a space like life sciences where your niche or your demographic is so narrow as far as prospective investors. Okay, and to ensure the successful implementation of your capital formation plan, that's where the next 4 hacks come in. You will be well served to stress test your capital formation plan. Again, use an investment banker as a sounding board if you can. Think several milestones into the future. What is your next offering going to look like, and your offering after that? How is all of that future capital raising going to impact what you're doing today? Number 5, make it your mission to understand your investor's thesis. Know what they are looking for. If you come to the table and just think every investor is the same, you're putting yourself at a huge disadvantage when it comes to negotiating. Okay, number 6, never get out of capital raising mode. Again, capital raising is all about momentum. You slow the car down, it's going to be just as hard to raise capital in the next offering as it was in this offering. But if you keep it going, you keep educating your prospective investors, keep them up to date on what you're doing, building that excitement, it's just going to get easier and easier for you as your company reaches, the milestones ahead. Number 7, design your capital formation plan around not having to raise capital whenever possible, as crazy as that sounds. Now, I won't rehash everything we just said in the last slide, but in general, that type of thinking is going to come with a whole bunch of ancillary benefits. And, maybe I would say if I was ranking these hacks, maybe, the second most important hack on the list. Again, these are all nuggets of wisdom that I have picked up while participating in the capital raising process as an attorney, an operator, an investor, and things that I think can be highly valuable for anybody who's trying to raise capital at the moment, especially in this space. Okay, now a few of the hacks we covered required some special tools to implement or resources, and I'd like to go over those here. As for developing and supporting a second market in your stock to address your time horizon challenge and broaden your reach to prospective investors, I would advise engaging with a platform that does not have a stock quoting feature. As for creating a platform for investor education to help investors navigate through all the data necessary to properly understand your opportunity, you're going to have a whole bunch of information that you're going to want to share with your investor base, and you're going to want to make sure that that's organized properly and that that's in a format that's going to allow investors to kind of navigate through it on their own terms. Okay, moving down the list. To execute your ongoing digital roadshows to help you build solid investor relationships over time, I would highly advise engaging with a branding agency such as Linked Media. Now, Linked Media puts on the CapCon venture conferences like the one we're speaking at now. And what I like about Linked Media is that they are focused on really a decided niche, specifically life sciences companies. And they want to work with these companies in a capacity where they can provide marketing services not only for the capital raising process, but also for the core business objectives of your company. So I think the two actually go hand in hand. I think, if you communicate with your prospects. Okay, moving down the list. Find somebody who knows your niche. Use them as a sounding board to develop your long-term plan. And one firm that I really like in this space is Alira Health for life sciences. I've had a podcast with David Uffer, which is available on Spotify. If you check out Inside the Glass Box, you can look for our interview with David Uffer, and you'll get a little sense for Alira Health's background and what they do. And they're really a perfect fit because they have an advisory arm as well as a banking arm, and they're somebody that kind of knows the market, knows what's going on at the very moment. And it's not just them, by the way. I mean, I'm putting names up here, even our own firm. We aren't the only people that provide these services. Alira isn't the only banker, obviously, that's qualified in this space, but they're a good start, if nothing else. Okay. So this brings me to the conclusion. That's it. 7 hacks to help you address the challenges associated with raising capital as a private life sciences company, and a few tips for implementation of those hacks. If you're an executive or principal with a life sciences company and you'd like to speak to me directly about anything I've discussed in this presentation, please feel free to reach out to me using the contact info here on this page. If you are an investor and you'd like to register to be notified of upcoming direct investment opportunities or second market investment opportunities on the Glassbox platform, please visit our website at glassboxlaw.com and check out our deal dashboard registration page. That's where you'd sign up to be notified of opportunities in the future. And finally, if what I've discussed today has been of interest, you may also want to check out our podcast called Inside the Glass Box, as I mentioned, on Spotify, where I have a couple of interviews that tie into this presentation, not only the one with David Uffer, but also one with Frank Aziz, who is the individual putting on this conference. And he's behind Linked Media. He's the one who kind of put everything together today, and I appreciate him inviting me to participate. So with that, I'm finished, and happy to take questions here, and also happy, again, if anybody would like to contact me in the future. Thank you.